The latest CPI data has just come out and the markets are going insane. This latest CPI print has shown cooler than expected inflation, and this has really affected expectations over the coming Fed rate cuts. In fact, as I'm making this video, we're awaiting that Federal Reserve decision on their benchmark interest rate. We'll also get an updated Fed dot plot, and therefore it'll be a lot more clear to investors what rate cuts to expect moving on to the end of 2024. However, in the meantime, we do know that inflation has cooled down, and this definitely supports the narrative that inflation is cooling while the economy seems to be holding up decently well, and that therefore we could indeed get some Fed cuts in the coming few months, and then of course a soft landing. Now, while the lower CPI print may seem on the surface like good news, and I don't disagree with this point, I also think we have to begin to worry about the other end of the tail, and that is, now that we can see that inflation is clearly cooling, can we see any weakness in the economy? That's exactly what I'm going to talk about today. We're going to point out some key indicators that show us that in fact the US economy could be much closer to a recession than a lot of people think. With this in mind, I asked the question, can the Fed actually prevent a recession? We'll be looking at historical data and recalling past recessions to understand how the Fed cycle of hiking and cutting plays into the US economy and what we can expect in the next 6 to 12 months. So with that said, let's get right to it. Starting with the latest CPI numbers, the Consumer Price Index headline number was flat in May, cooler than the 0.1% increase expected, and stalling from the 0.3% increase in April. On a year-on-year basis, CPI increased 3.3% compared to the 3.4% expected, which was also the same level as last month. So in other words, we've got lower than expected month-on-month CPI and core CPI, and also lower than expected year-on-year data. Now, although prices aren't actually decreasing yet, in other words, we're not getting deflation, the rate of increase has clearly slowed down. And therefore, I would say that this inflationary narrative has been supported in this latest release. In response to this, we've seen yields slip, and of course, the market has just reached new all-time highs. Nasdaq is up close to 2%. Bitcoin has rebounded very strongly after selling off yesterday. And all of this while we await the next Fed decision. Indeed, markets seem to now be pricing a soft landing, and I'm here to pour some cold water on that theory. Let's just look at some of the most recent macroeconomic data in the US. First, and most notably, a look at the unemployment rate. As we can see, the unemployment rate has climbed up to 4%, increasing for the third month in a row. The weakness in the labor market can also be appreciated if we look at total quits. Employees are clearly a lot less keen to quit their job, with few opportunities in the job market. I think this is pretty clear, not only that the data is showing an increase in unemployment, but also the negative sentiment around the employment market in general that is slowly beginning to develop. On top of the employment numbers, credit markets are also flashing a warning signal. Now, of course, the lower grade CCC bonds are beginning to appreciate in value, the yield is going up, while the safer -B bonds are beginning to decline. And as we can see, this spread, this difference in the prices, could be indicative of something major around the corner, as was the case if we look back at 2019 to 2020, when we got, of course, the COVID crash. On the other hand, we can also point to the fact that the consumer is starting to feel the squeeze. As we can see, the excess savings from the pre-pandemic stimulus have now been completely depleted. During the COVID pandemic, this fiscal stimulus that leaked into the economy has really strengthened the balance sheet of consumers and businesses alike. However, as we can see in the case of the consumer, their excess savings have already been depleted. On the other hand, we could see that leverage overall, so to speak, is increasing if we look, for example, at the US debt service ratio. The debt service ratio basically outlines what percentage of a person's income in general, of the consumer's income in the US, is used to pay back their current debt. In this regard, we can see that again, we reached lows after the pandemic stimulus, but now we're back over 15%. And bear in mind, this is data from 2023. And we're actually not that far from the peak of 18% that we saw leading up to the great financial crisis. Lastly, we can also see that real GDP is starting to decline. As we can see in this chart, real GDP is beginning to turn, although the leading economic indicators still don't suggest a recession is on the way as they keep turning up. However, there's been plenty of instances when we've had recessions and the leading indicators didn't really foresee it. So with the latest inflation print, everyone is now expecting the Federal Reserve to ease off the gas, cut rates, and therefore drive us into a smooth landing. But is this a realistic expectation? Now, let's determine this first of all by looking at a record of hard and soft landings. The above research from IWM Financial lays out the previous tightening cycles and whether a soft or hard landing was achieved. On the chart above, we can see interest rate and inflation plotted against each other. In more recent history, 1995 clearly saw an instance where a soft landing was achieved. And this is actually not an unsimilar situation to today. Inflation was running at around 3%, unemployment was close to 6%. The Fed tightened in 1995, and a soft landing was achieved. Then we saw markets roar throughout the 1990s on the back of the internet narrative, and then of course we got that big crash in 2000, 2001, at least in terms of the market. As we can see, actually this period is marked as a soft landing. Here's a quote from the study itself. Was that a hard landing? Not very. The 2 non-consecutive quarters of negative GDP growth in 2001 was so small that they left GDP for the year as a whole higher than in 2000. For that reason, I have long called this a recessionette. Regardless of terminology, the landing was on the soft side. So it's definitely kind of interesting to see that while we did get a very mild recession in 2000, we also saw a huge market crash happen. And like I pointed out, this situation isn't that unsimilar to today. We had a soft landing, and then a market that roared on throughout the rest of the decade, achieving super high valuations and eventually crashing. This was all led, of course, by the internet narrative, which was a great technology, but people got ahead of themselves. Could this be the case with what's happening today with AI? That's not the topic of today's video, but the situation could play out in a very similar way. But back to the question at hand, can the Federal Reserve actually prevent a recession and engineer a soft landing? Now, according to the data above, it's actually not that unreasonable to expect a soft landing. According to the data above, the Federal Reserve has achieved around 5 soft landings since 1963, and also having 5 hard landings. But as a pragmatic investor, what we're concerned about is not necessarily recession, but the possible effects this could have on the market. In other words, the question here is, what can we expect moving forward in this current cutting cycle? With the Fed about to cut rates, is this the time to buy or sell? Well, again, we could look at historical data to at least get some sort of an idea of what could happen. 3 out of the last 5 instances, the first rate cut has been followed by 12 months of positive and well above average returns. However, in 2001 and 2007, we saw above average losses. So it's pretty clear that either a soft landing is achieved and the markets welcome the rate cuts, or the rate cuts simply precede a large degree recession and a market sell-off. Now, it's important to understand that there are a lot of other factors at play here that aren't just about the Federal Reserve cutting. Yes, overall, we could say that the Federal Reserve cutting is at least good for markets, and this is certainly going to help add liquidity to markets, help keep valuations up, but to that extent, is it going to help prevent a recession? I don't think it quite works that way. The economy is, of course, a lot more complex than that, and there's a lot of moving parts to this. In this regard, we must distinguish between what is market valuations and the stock market and the broader economy. Now, it does seem like some of the data suggests that the US economy could be slowing down. However, there's definitely not enough yet to call for a recession. On the other hand, I would also agree with people who say that the stock market could be overvalued. There's definitely some signs of overvaluation out there. And just to wrap up, I also wanted to show you this chart right here. What we can see here is that the percentage of stocks outperforming the S&P 500 index is at record lows. Only during the 99.com bubble did we see this kind of behavior. Essentially, this is showing a great lack of market breadth. And this is definitely an important indicator to look at now. If market breadth can't improve from here, then I would certainly say it's a lot more likely that the market is getting close to a top. So all in all, this is what we've learned today. Recessions are hard to predict and even harder to time. The Fed does not control everything, and just because the Fed is about to cut doesn't necessarily mean we're going to have a soft landing. Thirdly, recessions and market crashes don't necessarily need to go hand in hand, or at least they can definitely vary in their size. So with that said, as an investor, what's most important is to have a clear understanding of what our objectives and time horizons are. Now, if you'd like to learn more about investing, get weekly macro insights, also in-depth stock research, and also technical analysis and trade ideas, I highly suggest you go ahead and follow me right here on YouTube. But most of my work is also on Substack. You can follow me there, The Pragmatic Investor. The links will be below. And as always, I hope you enjoyed this video, and I'll see you in the next one.